You probably bought an index fund because it was supposed to be the safe, simple choice. No picking individual stocks, no late nights reading earnings reports, a reliable way to put your money to work and let time do the heavy lifting. This chart illustrates the traditional concept of a broad market index. A broad market index is a standardized collection of stocks designed to track the overall performance of the entire market. The logic is straightforward. Instead of betting on one company, you buy a tiny, evenly split piece of the whole system to spread out your risk. Decades of financial research back this strategy up. Over long periods, even well-paid professional money managers consistently fail to beat that smooth, steady index average after you factor in their management fees. But the mechanics inside that index have quietly shifted. A small group of very large companies has grown so massive that they now take up a highly disproportionate amount of space in the fund. Suddenly, a massive chunk of your savings sits in just a handful of giant tech companies. The strategy meant to free you from tracking individual stocks has tied your net worth directly to the performance of a select few corporations. You are not looking at this to panic. You are doing it because knowing exactly what you own is a prerequisite for protecting it. Buying an index fund is meant to eliminate concentrated risk. If you ignore how top-heavy the market has become, you are quietly absorbing the exact risk you paid to avoid. Let's do a quick audit right now. Open your investment app or website, navigate to your main index fund, and locate the list labeled Top 10 Holdings. Look at the percentage next to those top names. Then ask yourself, am I comfortable having this much of my total wealth tied to the daily operations of these specific companies? It is incredibly easy to set up an automatic monthly contribution to a recommended fund and completely tune out. That habit feels responsible. Here is the structural problem. Because modern index funds allocate money based on a company's size, every time an automatic deposit hits your account, a larger share of your cash is fed directly into those few massive companies at the top. This creates a highly specific dynamic. When those massive companies are having a good quarter, they pull the entire fund up with them, making your portfolio look incredibly strong. But the inverse is also true. If regulators crack down on those specific firms or their sector hits a rough patch, your supposedly boring, steady investment will swing much harder than you anticipated. When the contents of the fund change, the rules change. Continuing a set-it-and-forget-it routine in a highly concentrated environment turns a conservative savings plan into an unpredictable gamble. It is deeply frustrating. You read the retirement guides, listened to the experts, and bought the broad fund. You followed the rules, yet the financial ground is shaken underneath you. My name is Alex. In my mid-20s, I took my entire investment portfolio and parked it into a single index fund. I didn't check the holdings or read the prospectus for years. I did it because every personal finance book and coworker told me it was the smartest, most mathematically sound play available to a normal investor. This visual represents what I found when I finally audited my own accounts. I wasn't buying the whole haystack. My money was heavily concentrated in just a few massive tech firms. I had paired excellent saving habits with completely outdated assumptions about how index funds operate today. That combination left me far more exposed than I realized. Let's be clear, index funds are not broken. They remain one of the most efficient, excellent tools an everyday investor can use to build long-term wealth. The financial vehicle itself is fine. It is only the old advice, the rigid instruction to pick one fund and never ever look inside it again, that requires an update. The market structure has evolved. Deciding to pretend that nothing has changed is the fastest way to put your financial timeline at risk. You do not need to abandon your current strategy. No panic selling, no day trading, and no expensive portfolio managers. The actual solution is highly manageable. You just need to make a few straightforward adjustments to your portfolio to counterbalance the sheer size of the companies at the top. But to make those adjustments effectively, you first need to understand exactly how these modern funds sort and weigh companies behind the scenes. Next, we are going to look straight into the underlying math of these funds. Once you see the mechanics at work, you can easily reclaim the diversification you originally signed up for. Let's start with a basic assumption. Millions of people buy stock index funds thinking they know exactly how their money is being distributed. But there is a massive misunderstanding about how these popular funds actually work beneath the surface. Mechanically, an index fund is just a single basket of investments. It is built to track a specific, predetermined list of assets. In this case, hundreds of large, publicly traded companies in America. The promise of this product is incredibly appealing. When you buy a single share of that fund, you are simultaneously acquiring a microscopic piece of every single company on that list. Think of it like ordering a sampler platter at a restaurant. Instead of picking one dish and hoping the chef nails it, you get a little bit of many different dishes. If the chicken is dry, your entire dinner isn't ruined because you also have the ribs and the brisket. That is the basic logic of diversification. By spreading your capital across hundreds of different corporate entities, you create a safety net. If one company fails, the overall health of your portfolio remains intact. This strategy became incredibly popular because it was simple to understand and notoriously cheap to maintain. This chart illustrates a painful truth. Over long periods, professional money managers consistently fail to beat broad market indexes after fees. Because the math favors the index, conventional wisdom became straightforward. Buy a broad fund, keep contributing, and let compounding do the heavy lifting. This expectation of steady, effortless growth turned into the unquestioned bedrock of modern retirement planning. It worked so well that it effectively trained investors to stop paying attention to what was actually inside the basket. But here's where the mechanics of that basket get tricky. If you assume every company gets an equal slice of your money, you are mistaken. Many of the most popular funds operate on a specific structural rule called market capitalization weighting. Market capitalization dictates a company's exact percentage of space inside the fund based on its total value. The math is rigid. If a corporation grows 10 times larger than a competitor, it takes up 10 times more space, absorbing 10 times more of your capital. When the hundreds of companies in the broader market are growing at relatively stable, similar rates, this proportional system hums along without an issue. But it also means the fund is not actively balancing your risk. Instead, market cap weighting creates a passive mirror of the market's biggest entities, systematically removing any guarantee of equal representation. We hit a modern tipping point when a highly concentrated, very small group of companies begins to grow at a drastically faster pace than the rest of the list. Watch a broad 500 company index when a few experience hypergrowth. Their success forces them to cannibalize a massive percentage of the fund's available space. Today, a tiny handful of megacorporations have swelled to represent a dominant, outsized portion of the world's most widely held funds. Going back to our restaurant order, the sampler platter has become severely lopsided. You are technically still getting a taste of everything, but a few giant items now take up almost the entire plate, while hundreds of other items barely register. Everyday investors checking their portfolios believe they are buying the broad safety of the entire market. In reality, they are making a heavily concentrated, leveraged bet on a tiny fraction of current corporate giants. It is worth noting that this exact weighting mechanism applies across multiple financial products. Whether you own an exchange-traded fund, a basket of assets you can trade instantly like a stock, or a traditional mutual fund, the mechanics are identical. The packaging and the marketing might look completely different, but the underlying basket of investments is tracking the exact same lists and building the exact same structural concentration. This creates a massive blind spot. People assume buying an index fund automatically means owning the market in equal proportions. Instead, you own a version of the market that aggressively leans toward whatever happens to be the largest right now. Here is the chart again to illustrate the danger. This vulnerability is called concentration risk. When those few massive top-heavy companies inevitably stumble, they create a disproportionate negative shockwave. Because they take up so much space, their losses drag the whole fund down with them. Your money looks diversified on the surface, but true protective diversification is an illusion if the underlying math inherently clusters the majority of your capital into a single massive point of failure. None of this makes index funds a bad financial choice. They are not inherently broken, and they remain excellent wealth-building tools. The issue is simply that the automatic, flawless diversification you expect is much less complete and less inherently protective than the surface-level marketing suggests. Successfully using these funds moving forward requires a higher level of structural awareness. You have to trade blind, passive trust for an active understanding of what you actually own. The strategy can still work brilliantly, but once investors realize their safety net has a massive hole in it, they tend to overreact. Let me show you the specific mistakes most people make the moment they try to fix it. You put your money into an index fund, assume you own a tiny piece of everything, and sleep soundly. Then you read a headline pointing out that your perfectly broad fund is actually heavily concentrated in a handful of companies. That realization usually triggers a jolt of anxiety. Wanting to fix a vulnerability in your portfolio makes sense. You want to protect your savings. But acting on that immediate instinct often makes your financial position worse, not better. When you react to new information out of surprise or fear, you abandon your long-term strategy. That shift from a calm, systematic approach to reactive scrambling has a high probability of costing you actual money. The underlying issue is a gap between what an index fund actually is and what we assume it does. Misunderstanding the limits of this tool sets investors up to make 5 specific, entirely preventable mistakes. Mistake number 1 is assuming that buying a single popular stock fund automatically means you are fully diversified. Owning pieces of 500 companies sounds like plenty of protection, but the sheer number of holdings does not equal a balanced portfolio. This chart shows how an index fund is weighted. Even with hundreds of slices, you can see the vast majority of the value clustering heavily to one side. This is called portfolio tilt. A tilt is a condition where a fund is heavily concentrated in a specific sector, company size, or geographic region, rather than being evenly distributed across the market. If the bulk of your investments are tied to the same part of the market, they will react to the exact same economic forces. When those heavily weighted sectors take a hit, your functional diversification proves much weaker than the sheer volume of holdings implied. That realization leads directly to mistake number 2, overreacting and abandoning index funds entirely. Investors spot the concentration risk and immediately want out of the strategy. Once they leave the fund, their behavior usually gets erratic. People try their hand at picking individual stocks. They chase whatever new investment vehicle is trending online, or they try to time the market by jumping in and out based on the daily news cycle. Index funds work precisely because you do not have to guess which specific companies will succeed. Leaving a broad approach to bet on individual corporate winners reintroduces the exact volatility and risk you were trying to avoid in the first place. A consistent system that you can stick with over decades is highly effective, even if the fund structure has flaws. Tossing out the entire system to rely on random guesswork creates much larger financial hazards. Mistake number 3 is treating the recent outperformance of the American stock market as a permanent, unchanging law of economics. American stocks have done exceptionally well for a long time, convincing many investors that looking outside the US is a waste of time. This map shows how active economic growth indicators move across the globe. Global financial markets operate in long-term cycles, meaning international market leadership inevitably rotates over time. Assuming one specific country will maintain its lead forever is a massive, highly speculative bet. That brings us to mistake number 4, confusing a lower-risk investment with a no-risk guarantee. Index funds are frequently marketed as the safer choice compared to picking individual stocks. This line graph shows an index fund's typical performance over a long timeline. While these funds dilute the risk of any single company failing, they are still physically tethered to the broader market. That means they will inevitably experience steep, prolonged drops, sometimes languishing in a flat valley for months or years before recovering. If you enter the market expecting a smooth, uninterrupted climb, your expectations are out of sync with mathematical reality. When those inevitable bumps hit, the surprise pushes you to make decisions based on panic rather than historical data. That emotional response leads to mistake number 5, selling your shares during a market downturn. This graph illustrates what happens at the bottom of a market valley. There is a rigid mathematical difference between enduring a temporary, unrealized drop in a fund's value and deciding to cash out. When you sell at the bottom, you actively lock in that lower value and turn a temporary decline into permanent financial damage. By removing your capital during a panic, those dollars are mathematically eliminated from capturing the eventual market recovery. Your money sits flat and stagnant, while the rest of the market steadily climbs back up to its previous highs. The reason investors pull out at the absolute worst possible time comes back to a shattered illusion. They interpreted relative safety to mean their account balance would never go down. All 5 of these behavioral errors originate from the exact same place. Investors are repeatedly told that index funds are a perfectly simple tool, so they make the decision to stop paying attention to their portfolios entirely. Once you spot the flaws and concentration risks inside an index fund, the correct response is absolutely not to quit the strategy. The solution is to invest with active awareness. You need to understand exactly what your chosen fund is designed to do, and just as importantly, what it is incapable of doing. When you align your expectations with actual market behavior, the surprises disappear. That clarity transforms an index fund from a blind leap of faith into a resilient, long-term system for building wealth. Buying a single index fund and ignoring it completely is a common approach, but it often leaves gaps in a financial defense. That oversight can lead to unforced errors when the market shifts. We can address this with a 7-step blueprint. It is a methodical plan to build a resilient portfolio without adding unnecessary complexity to your daily life. Setting this up requires a focused burst of organization at the start. Once the structure is in place, the system runs on its own. By following this sequence, you replace the anxiety of guessing what to buy with a calm, consistent process. Step 1 is mapping everything you own. Log into your current workplace retirement plan, your individual brokerage, and accounts from previous jobs, combining them into one unified view. You cannot build a better portfolio until you establish an accurate baseline of your current holdings. Step 2 addresses a structural limitation. Many portfolios are concentrated in large company stocks, leaving them sensitive to a single sector's performance. This diagram shows the effect of adding small or mid-sized company funds. Smaller companies respond to different market forces and distinct economic cycles. A modest allocation changes the behavior and risk profile of your total holdings. Aggregating accounts and adding smaller companies creates a portfolio tracking multiple parts of the economy simultaneously. Step 3 reduces the risk of tying your retirement to the performance of a single domestic economy. A single, broad international index fund captures shares across dozens of global markets, establishing worldwide exposure in one purchase. Integrating large companies, smaller companies, and international markets provides a structural defense that a single fund approach lacks. Step 4 secures this structure by establishing a written target allocation. Decide exactly what percentage of your money belongs in domestic large companies, in smaller companies, and international markets. Depending on your age, you may also assign a portion to bonds or cash reserves. This notepad shows percentage targets secured behind a shield. During market volatility, this written plan serves as a logical anchor instead of your emotions. Documenting your allocation strategy stops you from reacting to sudden news. You follow your established math. Step 5 addresses allocation drift. As you see in this chart, drift occurs when assets grow at different speeds, causing one category to swell. The fix is annual rebalancing. Once a year, you shift funds back to your starting target. Step 6 removes the friction of manual investing. Set up automatic transfers into your accounts on a rigid schedule, every paycheck or once a month. Notice how this automated pipeline operates. By investing the same dollar amount consistently, you automatically buy more shares during market dips and fewer shares during market peaks. Strict automation bypasses manual decisions, making it easier to stick to the plan during a downturn. Step 7 is about restraint. Pick exactly one day a year, like your birthday or the 1st of January, for a full portfolio review. Review your balances, rebalance if needed, and immediately close your accounts. Checking weekly increases the likelihood of emotional decisions that damage your returns. Automated inflows and an annual review ensure the strategy stays on track without demanding daily attention. Index funds remain one of the most reliable wealth-building tools available, but the idea that you can buy one fund and never look at it again is often an incomplete strategy. A resilient strategy requires intentional asset balance, a clear awareness of your holdings, and a rigid, automated maintenance schedule. Look at the schedule on the screen. I post new financial strategies every Tuesday, Thursday, and Sunday, so hit subscribe. If you know someone who keeps all their money in one unchecked fund, send them this video and comment one fund or many below. Ultimately, diversification is determined by the automated behavioral system you build to protect your assets year after year.